Imagine you have 30% of your portfolio invested in a stock, a market leader in their respective industry, and then you have 15% of your money invested in a startup that is not profitable, has a single product line. You want to pay more attention to holdings that make up a big percentage of your portfolio because there's a higher risk for that holding to affect your portfolio return. But is that actually true? What is useful is that this report put all this information at your fingertips. Hi everyone, welcome to the channel. Today I'm going to talk about the diversity report. So this is one of my favorite reports that I use quite often. The diversity report is a powerful tool. As the name implies, the report shows your portfolio diversification and where your money is allocated. Now, why is this important? Put it simply, the reason you want a clear picture of where your money is so that you can better manage your risk. Investing is all about managing risk. In general, there are two types of risk: market risk or specific risk. Market risk is a risk that is triggered by events such as geopolitical, macroeconomics, or financial factors. For example, changes in interest rate, trade tensions between countries, or credit crises such as the GFC are all market risks. Market risk can affect the overall market or a particular asset class, and generally you have little to no control over it. However, that is not to say that there's nothing you can do about it, which we'll discuss later. The other risk is specific risk. This is the risk where it is tied to individual investments within your portfolio. So if you can think of a company that is not doing well because of competitions, cash flow issues because of debt obligations, or delays in important product launch. These are all risks that is tied to individual investments. Diversity report is powerful because it gives you a good understanding of these two types of risks so you can better prepare and manage them. Now let me show you how to do it. From the overview page, select the Reports tab. The diversity report is under the Performance Insight section. We are in the report. You can use the date options to examine your portfolio diversification at any point in the past. We have set this to do not group. This means the report will show the weighting of each holding. This weighting changes daily because of the share price movement. I can sort these holdings by percentage weighting. For example, Apple is the biggest holding in this portfolio, making up 20% of the total portfolio value. As we discussed earlier, if I have 20% of all my money sitting in Apple, that means I should pay more attention to these stocks over any other stocks, right? Because if anything bad happens to this stock, it is going to affect my portfolio return in a big way. There isn't a specific percentage before an investment is considered as too risky because it depends on factors such as your age, your risk tolerance, and the nature of the business. What is useful is that this report put all this information at your fingertips and you can decide if you want to do something about it. Now assume your portfolio is well diversified. You don't have any holdings that makes up a large chunk of your portfolios, but that doesn't mean everything is fine, right? What if most of your investments are concentrated on a particular industry like tech or mining? Again, you can use this report to find that out. If we change the settings to group by industry classification, you will see your investments get grouped into their respective industry. This gives you a clear picture if your portfolio is overexposed to a specific industry, especially if it is highly cyclical. Cyclical industries are closely tied to the overall economic cycle or business cycle. These industries experience periods of expansion and contraction in sync with the broader economic trends. If your investments are concentrated in cyclical industries, then you have to pay close attention when the expansion phase ends. Apart from industry groups, you can group your holdings by sectors, markets, investment types, currency, and country. As I mentioned earlier, you want to pay more attention to holdings that make up a big percentage of your portfolio because there's a higher risk for that holding to affect your portfolio return. But is that actually true? Imagine you have 30% of your portfolio invested in a stock that has a strong growth track record, is a market leader in their respective industry, and pays dividends consistently. And then you have 15% of your money invested in a startup that is not profitable, has a single product line and derive most of their revenue from a single customers. Now, which one is more risky? That's when things become interesting, right? So there are things where you can't tell by just looking at the individual holding weighting. And this is where the custom group comes in. There's a link below on more about custom groups. Custom groups are basically a way to group your holdings in the way you want. And that can be because you have different strategies, or like I said earlier, you might think it is worth paying some attention to the startups where you have 15% of your money sitting in there. You can create custom groups to group these holdings based on similar characteristics or attributes to help you make a better investment decisions. I've created a custom grouping, so I'll apply it to this report. You can see I've grouped these holdings based on their attributes. Again, this is just an example. So this makes it easier for me to understand how my money is allocated and whether I need to do something about it. So for example here, I might think there's a significant gap between growth and value stocks that I want to balance things up a little bit. Custom group gives me a crystal clear picture on how I can rebalance my portfolio composition to align with my long-term financial goals. If you have more than one portfolio in your Sharesight account, whether that's because you're managing investments for your other family members, or just simply because you have different tax portfolios, you want to have a bird's eye view of where all your money is allocated. And that's not just one portfolio, but all of them. You can create a consolidated view and run the diversity report in that view. Here you can see I got a consolidated view that combines two portfolios, and I can run the diversity report here, which gives me a complete view of where all my money is. You can see under the do not group settings, apples are in both portfolio. I can expand this to see the weighting of Apple in each portfolio. And I can also drill down into each individual portfolio here by grouping them into portfolio. This is how you use the diversity report to control your risk effectively. What makes it easier to understand your diversification risk. Thanks for watching this video. If you like this video, please give it a thumbs up. Make sure you follow our social media for more features on Sharesight. See you all in the next video. Bye.